Good morning, students. Welcome back to the session on audit. So today we are going to continue that discussion on audit of insurance companies. So just doing a quick recap of whatever we discussed in the last session. Basically, it's about the audit of insurance company, wherein we understood that this is a specific sector which is subject to specific regulations, and that's why there were certain schedules over which we had a decision. One was Schedule A, which was meant for the life insurance companies, wherein we discussed some of the regulations related to the preparation of the financial statements, the disclosure requirements therein, and some of the instructions which are there for preparation of the financial statements. Then we also understood that there are certain points, areas over which management is required to give a specific representation, but that is something which will form part of the financial statements in case of insurance companies. And all of these aspects are required to be reviewed, or you can say audited by the auditor of an insurance company. In respect of this insurance company, which is about life insurance, we understood that some of the critical items which will be there in the financial statements would include their revenues, which is nothing but the premium, would include their direct costs, which is nothing but the claims, and then of course various line items which we see in case of any would include their revenues, which is the insurance company, be it salaries, be it interest, or be it some sort of admin expenses. Yeah. The next aspect was about the general insurance companies, which will have similar sort of items, or you can say components in their financial statements, that is about premium or about claim, and wherein we also understood that the procedures would largely remain same. The only thing is, because the nature of the business is different, so that's why when the auditor will approach the audit of a general insurance company as compared to a life insurance company, certain specific points which are related to general insurance companies is something which you have to look into. Otherwise, his overall approach is largely similar to what we follow in case of life insurance companies. And in case of general insurance company, again we had a discussion around some of those regulations which are required to be followed. And for life or for general insurance company, there's a specific schedule. Schedule means some part of those regulations which are specific to a general insurance company, and that was Schedule B. When we discussed about the preparation, about the instructions for the financial statements, about specific disclosures which are required to be given, here again we had some disclosures in respect of the specifications, or you can say the representations which will be given by the management, which is in the nature of a certification or authentication. Yeah. Further, in case of a general insurance company, because the nature of businesses could be various as compared to life insurance, where the business is only life insurance. So that's why when we prepare the financial statement, the revenue account, which is again a specific requirement of an insurance company's financial statements, those will be prepared separately. Correct? Yeah. We were talking about audit procedures as around all of these items that we have discussed so far. Yeah. Now, moving further on to the areas which are required to be audited by the auditor. In respect of general insurance company, another area is about the commission or brokerage which is required to be paid. And over commission and brokerage, we discussed certain audit procedures when we were discussing the life insurance company. So now for a general insurance company, what will be the set of audit procedures? This would again be similar sort of audit procedures. The only thing is the workings will now be for a general insurance company as compared to a life insurance company. Means when it comes to the audit, so we'll also be looking at the commission working, we'll be looking at the number of agents which the company will be having, and the commission which is percentage agreed with the commission agent that is required to be paid. So one is the completeness check. Second is about the testing of the documents or agreements in respect of this terms of understanding between the commission and the between the commission agent and the insurance company. So similar sort of audit procedures would come over here as well. Yeah. So nothing specific is required to be considered except for what is there in case of a nature of business, or of course if there are terms which are agreed in a different manner. Yeah, so I'll not be just repeating one of these points. So when it comes to legal or professional charges, or when it comes to interest or bank charges, when it comes to depreciation, or when it comes to any sort of investment or the employee compensation, the audit procedures would again be required to be similar what we discussed in case of life insurance. Moving further, let's discuss about the cash and bank balances. Now, cash and bank balances is not the item which will only be there in case of general insurance. This will also be there in case of a life general insurance company as well as life insurance company. Now, talking about some of the audit procedures which the auditor will be required to follow, let's think about the audit procedures, and I will request all of you to also share the audit procedures in respect of cash and bank balances. Now, first, for the cash and bank balances, first, what is the audit procedure for cash? Physical verification. Correct? So, auditor will perform physical verification of cash. Second, he would also want to obtain a cash in hand certificate from the manager. But this cash in hand certificate should be specific to the year, which is nothing but the first March for insurance company. Moving on to the bank balances. Now, in respect of bank balances, when it comes to the audit, can you tell me one of the most important audit procedure which is required to be followed for any company? Forget insurance company, for any company, the procedure that comes to your mind. For a bank insurance or for a bank balance, which could be in the nature of any sort of bank balance. So quickly over to you. You need to answer this one. Now, when it comes to the bank balance, the most important audit procedure that we understand is about the balance confirmation. And this balance confirmation is something which the auditor does independently. Independently means independent of the management. So that means the balance confirmation will be rolled out by the auditor to the bank directly. And then the bank will confirm the balance to the auditor. Okay. Now this way, what will happen? Auditor will not only be relying on the internal evidence. Auditor is actually approaching the external party, and the evidence would therefore be the external evidence. Correct? Shraddha is saying, so bank balance is as per the balance in the bank, that is about the bank reconciliation. Yes, that's correct. Now for this bank reconciliation, auditor would want to obtain the bank balance, or you can say confirmation of this bank balance. Only then this reconciliation would be performed by the auditor, and this bank balance confirmation has to be done independently by the auditor. Yeah. Once this bank balance confirmation is obtained, the next step, of course, will be to do a reconciliation if there's any difference, which would generally be there, and over those reconciling items, auditor will perform different procedures. Correct? Yeah. So now, when we talk about this type of audit procedure, which is about bank reconciliation testing, or you can say a balance confirmation, which are required to be obtained. Now, are these very peculiar to an insurance company? The answer is no. Because this is something which you will do for any sort of company. This is not something which is specific to an insurance company. So that's why some of these types of items, as you would now understand, will require similar sort of audit procedures on the part of the auditor of an insurance company as well. Understood? Clear? Then the next procedure which Shraddha has specified is obtaining confirmations from banks regarding number of actual accounts maintained by the banks, which is about external confirmation. That's correct. And this will not be limited to the number of actual amounts or the number of actual accounts. This would also include the balances in those accounts. Yeah, so both the things are required to be covered. And this will not be limited to the balance of the current account. It could be about any type of balance or any type of arrangement which the company may be having with the bank. Here again, auditor will have to be looking into the various regulation which an insurance company may be subject to. Yeah, so that part will definitely come in. So now, I'm not really getting into too much details around this, because all of these line items will generally require similar sort of words. So what we can do is we can just pick up small questions based on some of these points that we have discussed. Yeah, and let's think about some of those points which we have already discussed while you answer this, because you need to answer this, because all of these points are something that we have covered by now. Yeah. So let's suppose if the auditor is now auditing an insurance company, say an insurance company is a general insurance company, wherein the management has computed certain amounts, or you can say there are certain balances which are appearing. It could be about the amounts which have been recognized during the year, or certain amounts which have been outstanding, means which have been continuing from the previous years. So I'm saying amounts which have been recognized during the year plus outstanding balances of previous years. Okay, now summation of these two is the closing balances of the current year. So you can say closing balance for the current year includes some part which is recognized in the year and some part which is outstanding from the previous year. And in respect of these balances, so I'm not talking about the nature of this line item, I'm saying some of these types of liabilities which have been recognized by the insurance company were subject to actuarial valuation. Okay. So these were subject to actuarial valuation. Yeah. Now, in respect of these balances, auditor understood. First of all, auditor had a detailed understanding about the process which the management would have followed as around the computations. Auditor has also gone through the workings which have been obtained from the management. So, a lot of audit procedures and now some of those points have been covered by the auditor. Now the auditor has understood that from the computation of all of these liabilities, actuaries were involved and which were third parties. Means these actuaries were not part of the company, but these are third parties. So actuaries were third parties. But you can say outside parties. Okay. Now the auditor wants to have a evaluation about those actuaries in terms of their competence. Secondly, the auditor also wants to have a discussion with those actuaries in terms of certain assumptions that they would have taken and various other aspects which the auditor wants to audit. So this dialogue auditor wants to have with the actuary directly. But the management is reluctant on this point. Yeah, the management seems to be reluctant on this point Because the management has provided all the required information to the auditor and which has also been audited by the auditor. Yeah. So that's why management is reluctant in terms of this decision of the auditor with the actuary. Yeah. Now, under this situation, and also considering the fact that the balances over here are material. These balances are material. Material means these are significant balances which are appearing over here. What should the auditor do, or what should be the course of action on the part of the management? Okay, let's think about some of these points. So what we can do is we can just pick up certain options that now under the given situation where the auditor wants to perform something but the management is really reluctant in terms of getting onto one of those audit procedures. What's the course of action which can be considered over here? So first is about getting access to the actuaries. So that means auditor should get access. Auditor should get access. Access means auditor should be getting access to the actuaries. So we should be allowed to speak to the actuaries, and any sort of evaluation as one of the competence of the actuaries should also be allowed to be done. All of these things should be allowed by the management. Otherwise, this will be considered to be limitation on the part of the audit procedures. Correct? So that's why the view which the management seems to have taken doesn't seem to be in line with the auditing standards. Number one. Number two. Now there are a couple of points which we need to consider. Currently, the balance which is subject to audit is comprising of two parts. One, which is about the balance of previous year and which has been continuing. And second is about the amounts which has been, or you can say, part of this balance which has been recognized. So this, let's suppose this amount is 20 crores. So 20 crore is not the amount which has been recognized during the year. Say 5 crore is the balance of the last year and 15 crore is the amount of the current year. Now, when it comes to the audit, auditor can definitely perform any audit procedure in respect of amounts which are getting recognized during the year. But something which is continuing from the previous year would have already been audited, so that's why there's no point auditor should get into that discussion. Okay, so therefore, auditor should be getting this access. So he should get this access to the information, to anything which he requires, but limited to amounts recognized during the year. Okay, that should be limited to the amounts recognized during the year. So when the auditor will be having any discussion, so he should not be talking about the entire balance. He should only be talking about the exports, and over 5 crore he should just ignore. And further about actually, he should not be really getting into this audit. Okay. Option number 3. Option number 3, we can say that because the management is not comfortable and because the auditor has performed the audit procedures, so that's why there's no need on the part of the auditor to get into this aspect of having discussions with the actuary or evaluation, because all of these things would have been taken care of by the management, and in any case, management is facilitating everything. Yeah, so that's why there doesn't seem to be any need, no need of performing such audit procedure. Okay. There doesn't seem to be a need for performing such audit procedure. Option number D is that auditor should again not get into this audit procedure because given the situation which he is into and forgetting all of these aspects, what he should simply do is considering the fact that it's an audit of an insurance company and also considering the fact that these balances are significant. You can say these are crossing the materiality threshold. So that's why he should specify clearly in his audit report that he is relying on these balances or not such amounts which have been provided by a third party. So that means give a note in his report that he is placing reliance on this. That he is placing reliance on this. And therefore, and because he is placing reliance on this, therefore, he again need not get into this procedure. Yeah, so again, option number D says, so option number 4, not D, option number 4 says that he should again not be performing this procedure and he should be specifying in his report that he is placing reliance on this and that is considered to be good enough. Now, what do you think in this situation will be the right option? Out of these 4 options, what would you think as an auditor, or what are your views? Means, what is it that you want to go back? Quickly, if you want to share anything, and if you can also let me know the rationale for choosing the option that you follow. What do you think will be the best option over here? Means he should still go at forming all of these procedures and or maybe he should just stay limited, talk to the management like, no, I don't want to perform procedure in relation to this entire balance, but this will be something which will be limited to the amounts recognized during the year. Or just put this in the report, which is something which is required by the regulations also, auditing standards also, and just close this discussion. So what is the appropriate procedure? So she is saying, sir, option number 4 seems to be the best thing, because this is something which will be the best solution, and this is not only the solution, this is also something which we should do, because as an auditor, he is relying on the work of a third party, so which is absolutely fine. Then Vijay Rashri says option number 3 seems to be correct. There is no need of getting into any such kind of audit procedure which is absolutely not required. Unnecessary auditor is wasting time over here. So that's why there's no point getting into any of these aspects. Any more options from your side? So let's evaluate both these options one by one. Okay, so I'll pick up first of all the options which we have shared. First option, sorry, this first option which you have shared is option number 3. So when we say no need of performing such audit procedure, this may not be approved. Why? Because when it comes to an external party whose work is being used by the management, so what is that external party? In a way, that is a management expert. Yes or no? And if the auditor is relying on the work of a management expert without performing the audit procedure, that will be considered to be inappropriate. Yes, so definitely we need to do something about it. So that's why this option doesn't seem to be correct. Moving on to option number 4. Option number 4 says that the auditor should again not be performing this procedure, but that he should specify the same in his report that he is placing a reliance on the work of a third party. If you look at the auditing standards, they clearly specify that the auditor is the sole person who is responsible. The auditor is the only person who is responsible for his report. He cannot place reliance on a third party and just do his responsibility or do part of his responsibility. Not allowed at all. So that's why this option number 4 is also out of the picture. This is also not possible. Okay. Moving on to option number 2 and 1. 2 and 1 require the auditor to go ahead and perform the audit procedure. Wherein option number 2 again limits the work of an auditor, which is not appropriate. See, as an auditor, what is it? An appropriate audit evidence and something which is required by the auditor as per his best judgment. Okay, therein, auditor cannot just stay limited to the amounts which are recognized. Okay, because when it comes to the closing balance, auditor is required to give his opinion on the same. And closing balance comprises of the entire amount, whether it's recognized during the year or whether it's a continuation from the previous year, or both the things. Auditor is required to perform the audit procedure, and that's why option number 2 is also not correct. So what is the right answer? Option number 1. That means auditor should be looking at everything which he requires. And if you look at the requirements of the auditing standard, they would require the auditor to evaluate the competence of any expert which the management would have involved in terms of various balances or in terms of various amounts which are appearing in the financial statements. Alright? Yeah? Okay, great. So, this was some of the audit procedures which the auditor would perform in respect of actual valuation particularly. So that is very, very significant component. See, actuarial valuation is something which is very, very significant component in a way, because a significant chunk of the liabilities of an insurance company are valued by an actuary. And as we discussed in the last session, that those actuaries may be in-house or maybe outsourced. It can be both ways. For both the things, auditor need to have a look at. Okay, now further on to one more point. So during the course of the audit, so we'll pick up one more example that will move further. During the course of his audit, auditor found that the operations of an insurance company are quite significant. Operations were quite significant. Yeah. And the insurance company is using IT environment in a very significant manner. Okay, so the IT environment, the IT controls, the IT reports, etc., those are all generated from the systems. Yeah, so management is quite significantly making use of the IT environment in terms of its operations as well as financial reporting. Operations and financial reporting for the management involves significant usage of IT systems. So IT systems are significantly used. Okay. Now, Auditor has tried to do the control testing, and on the basis of whatever limited procedures auditor has performed, he has found that the IT controls plus manual controls were operating effectively. For this company, IT systems, or you can say non-IT systems, all sort of systems, means IT controls, manual controls, those were operating effectively. Now, while performing the audit of premium, in terms of the substantive testing, it means during the course of substantive testing, auditor found that the number of customers of this company is running into lakhs. Data was voluminous. And that's why auditor picked up very few samples. Few samples were picked up by the auditor. Only. Yeah. And ideally, auditor should have involved an IT expert from his side, considering the IT environment of this company. But the auditor thought that all of these procedures that he had performed were appropriate. In fact, when it comes to the testing of the IT controls or understanding of this IT environment, his team, which was not really an IT expert, were performing all sort of audit procedures. Okay, so that means auditor didn't involve any IT experts from his side. Yeah. Now, what happened was, during the course of his audit, auditor also found some fraud. Yeah. And this fraud which he found was not something which he found on the basis of his audit procedures. This was something which the management had detected, and management communicated the same to the auditor. So management communicated to the auditor. Okay. Now, because of this, again, auditor formed a view that because there was a fraud in the company, so that's why there can definitely be a problem in terms of their systems. But because the management had communicated on his own about such fraud or about such instances to the auditor, so that's why it appeared to the auditor as if everything is okay because management is good enough. They've been taking care of all of these situations, and they are also making sure that they are updating the auditor. So the comfort of them. Okay. So again, because of such instance, the extent of the audit procedures which the auditor had decided, extent of the auditor we did change the extent. Says C by management. So in terms of their integrity, so he didn't have any problem. And anyways, this fraud was not something which was very significant. So this fraud was for an amount of say is only 20 lakhs. Not a significant amount. And for a company which is so big and which has significant operations, this amount was negligible. Okay. Now, considering the fact pattern that we have discussed, we can look at certain options. And you now need to understand and answer me which of those options will be considered to be correct. Alright? Number one. As of the testing of the IT systems, if the auditor has performed that and the auditor has found this operating effectively, this is absolutely okay. Absolutely okay in the sense means involvement of IT experts, whether auditor does that or not, that's his prerogative. Okay, and there is no necessity for the auditor to engage an expert. Okay, so that's why what we can say is approach, or we can say approach of auditor. So audit approach seems to be perfect, seems to be alright during the course of the audit. The only thing is that now because auditor has understood about this fraud, so that's why this fraud should be reported by the auditor in CAR. So this should be reported by the auditor in his CAR. Option number 1. Yeah. Option number 2. The audit approach doesn't seem to be correct. Why? 1. He has not involved the experts. So he should have involved IT experts. He should have involved IT experts. So that's why in the absence of the IT experts, to form a conclusion that the IT controls are operating effectively may not be correct. Yeah, because this may not be true. Number 1. Number 2, when it comes to premium, in terms of effective testing, he has only picked up few samples. See, for this large population and for an item which is premium and which is so significant, this is the most important component of the financial statements of this insurance company. Performing only one procedure and that too limited to sample testing is not appropriate. So premiums should have involved more audit procedures. So you can say audit should have been performed in a better manner. So I can say audit extent should have been increased. Number 2, our audit procedures should have been increased. And when it comes to the fraud, this is absolutely okay because there is something which is detected by the management, and because this is detected by the management, that's why there is this no requirement of this CARO report. So CARO should be given without this fraud. And anyways, this amount is not significant. Okay. Option number 3. Option number 3 says that involve IT experts in testing of premium should have involved more audit procedures. There should have been more audit procedures. So I'm just Same involved IT experts. Premium should have been providing more audit procedures. Okay, option number 4. Option number 4 says that because the auditor has kept his extent same. Yeah, this is something which we have understood. Why? Because after the fraud would have been identified, the auditor should have increased the extent of his testing, which is not in line with what we have discussed so far. So his extent of testing should have necessarily increased. In fact, generally, when he will understand about the fraud, and particularly for insurance company, what should he do? He should really think about whether to continue or not. So, due to this fraud which he has understood from the management, auditor should decide whether to continue or not. Which he didn't do. Number 1. Number 2, there's no doubt that this should form part of his audit report. If at all he plans to continue. So that means audit report including the card should definitely capture this fraud. Okay, yeah. So these are the options that we can think of in relation to the fact pattern that we have discussed. So now, you can just tell me which out of these options you will consider as the correct option or the best option. Yes, quickly, over to you. Out of these options, which option you would think is the best option? So we have 4 options over here. Given the situation which the auditor is into and the approach which we would have considered, which out of these you would want to consider? So Radha is going with option number 2. So Radha is going with option number 2. Yeah. Any more responses? Yes. Okay. Sushi is going with option number 3. And Sushi has given both the options, option number 2 and 3. No, it can't be both. Can't be both. So you need to pick one option. And Shraddha is going with option number 4. So we've got mixed answers. Yes, any more responses? So I think Sushi has changed. Is it? Yeah. Sushi is saying option number 2 only. 3 was by mistake. So option number 2 only. So 3 is not the option. Great. So let's evaluate all of these options, and I would request all of you to please answer this one and just try to bring in the rationale also. So Vijay Rashti is also given the response. So Vijay Rashti is going with option number 3. Okay. Alright. So let's think about all of these options one by one. When it comes to the audit approach, there are definitely problems. One, non-involvement of IT experts. Second, performing very limited procedure on an item, on an area which is of significant risk. Then disregarding this fraud. Why? Because not changing the extent of the audit testing, definitely audit approach is a question mark. So to say audit approach is appropriate will be incorrect. Yes, that's why option number 1 goes away. Yeah. Now, let's talk about option number 2 and 3. Now, in terms of option number 2, as we just discussed, that the audit approach seems to be a question mark. So that's why option number 2 largely captures those points. Challenges the audit approach in terms of involvement of IT, in terms of extent of audit procedures on a significant risk area. But at the same time, option number 2 carries one of the biggest problems which you would also make in the exam. Just give me 1 minute. Okay, so we were talking about option number 2. Option number 2 was all okay except for one point. It requires CARO reporting. Just give me 1 moment. Option number 2 requires reporting under CARO. But for an insurance company, is that required? No. So that's why, because of this point, what should we do? This is also incorrect. And that's why, which option will be considered to be correct? Option number 3. But we should also think about option number 4. Option number 4 requires auditor to evaluate whether to continue or not. Let's think about it. For a fraud, which we are saying is not so significant, right? Because the amount involved is not so good, and anyways, even if the fraud is big, so can the auditor just run away from his responsibility? No. Auditor need to stay over there and report this matter. So this option is not available to the auditor to just run away. To decide whether to continue or not will not be the right thing, will not be the correct approach. And of course, to report that in CARO for insurance company is not right. That's why option number 4 will also not be the right option. So what is the right option over here? The right option will be option number 3. Yeah, alright, clear on this. So now you would have understood that some of the common points which we ignore, and something which the examiner would also understand, that for an insurance company, whether this CARO reporting is required or not is generally overlooked by us. Yeah? So we'll just go by what is required for a company which is not an insurance company, and we'll just apply that. Yeah, so we need to be careful in terms of those specific points which are applicable only to the insurance business for the insurance companies. Fine. Yeah. All of you clear on this now? Okay, so now what we can do is we can just move further. Okay, so now moving further on to the next part, that was about Schedule C. So if you remember, we discussed Schedule A, Schedule B. Just give me 1 minute. Now we'll move on to Schedule C. Okay. So if you remember, Schedule C discusses certain requirements of audit specific to audit. So this is not about financial statements. This is specific to the audit. And this Schedule C is not specific to life insurance or general insurance. This is something which will become applicable to both. Yeah. So let's understand some of those requirements which is applicable to both the types of companies, life insurance as well as general insurance. Apart from the normal contents of the auditor's report, certain matters are required to be dealt with by the auditors in their report. Yeah, let's look at those matters one by one. Auditor needs to report that they have obtained all the information and explanations which to the best of their knowledge and belief were necessary for the purpose of the audit, and whether they have found them satisfactory or not. So now you can also say to a certain extent, this is similar to what the management was doing in terms of the contents of the management report. Therein, management was taking responsibility and certifying, authenticating certain points related to the financial statements. Now, over and above what the auditor would report, over and above his auditor's opinion, there are certain points over which auditor needs to have a specification in terms of his reporting. Next, whether proper books of accounts have been maintained, whether proper returns, audited or unaudited, from the branches, from offices have been received, whether they were adequate for the purpose of audit, whether balance sheet, revenue, P&L, all of these accounts were dealt with by the report. Receipt and payments accounts are in agreement with the books of accounts. Whether actuarial valuation of liabilities is duly certified by appointed actuary. So can you see this, the importance of this actuarial valuation? Auditor is required to specifically comment on this. Why? Because this forms a very significant component of the financial statements. Auditors shall express their opinion on balance sheet, revenue account, P&L, and receipt and payment. Yeah, this is something which is similar to any other company else. Then the auditor will also be giving their opinion on the financial statements. And what do they need to specify? That the financial statements are prepared in accordance with the applicable act, which is what? Insurance Act, AAPE, Companies Act, to the extent it is applicable and the manner it is required. Further, they need to give their opinion that the investments have been valued in accordance with the provisions of the Act. So as we discussed, that investments form a significant chunk of the financial statements of such companies. Accounting policies which have been selected are appropriate and those are in compliance with the accounting standards. If you remember, financial statements would also include a disclosure clause, and auditor is required to specifically capture this point in his report. Auditor shall further certify. So what they certify further? They have reviewed the management and there is no apparent mistake or material inconsistencies in the financial statements. The insurer has complied with the terms and conditions of the registration specified by the authority. Okay, so this is again a further specification in the auditor's report. Next, a certificate signed by the auditors, which is in addition to any other certificate or report, which is required by the law to be given with respect to the balance sheet, certifying that they have verified the cash balances, securities relating to insurance loans, reversions, life interests, and investments. The extent, if any, to which they have valued the investments and transactions relating to any trusts undertaken by the insurance as trustee, and no part of the assets of policyholders' funds has been directly or indirectly applied in contravention of provisions of Insurance Act. Okay. Yeah. So this is further on to the auditor's report. So a certificate in respect of all of these points is required to be signed by the auditor, and that needs to be included over here. Yeah. Clear on this? So you can see that over and above what is required to be reported for what you will see in case of a non-insurance company, there are certain specific points which the Act requires an auditor of an insurance company to report on or certify. Fine. Clear? Next, I think is a very general point which any ways we all understand, but let's get into this discussion also. Accounts and the statements. Accounts and the statements means financial statements and various components of the financial statements should be signed in case of a company by the chairman, if any, and two directors and the principal officer. Accounts and statements should be accompanied by a statement containing the names, descriptions, occupations, directorships held, persons in charge of the management of the business during the period to which such statement refers, and by a report on the affairs of the business during that period. Okay, yeah. So this is a specification in terms of who should be signing the documents and what all reports should be forming part of the various components of the financial statements. Okay, yeah. So with this, we come to an end to our discussion on the audit of insurance company. So before I wind up my discussion, let's do a quick recap. In case of an insurance company, what you understand, there are two types. One is life insurance, one is general insurance. Now, depending on the type of insurance, regulations will vary. So Schedule A, or you can say the part of this set of regulations apply only to life insurance. Schedule B, only to general insurance. And this Schedule C, which is limited to the audit requirements, and which is not talking about financial statements or all of these stuff in terms of their operation, presentation, etc., is applicable to both of them. Okay, clear? Yeah. And definitely there are various components of an insurance company which are very peculiar, which are very different from what you see in case of any other company that we have already talked about. Yeah. So before we move on to the next chapter, if there are any questions, any doubts, please let me know. Okay. So we'll move on to our next topic. But before that, if you have any questions, any doubts, please let me know. Yes, any doubts, any queries in case you have? So we'll move on to our next topic now, liabilities of auditor. Again, a very important topic for any auditor, and also considering today's scenario, wherein the requirements on the part of auditor has only increased. Regulations have become very stringent, and in respect of various aspects related to audit, auditor needs to be very, very careful. Otherwise, if there are any non-compliances, or you can say any breach of duty on the part of the auditor, or something which he was supposed to do but he has not done, then the liability for an auditor can be very, very significant, and at times it can also become onerous. Okay, yeah. Shraddha is asking, Sonia, before we move further, Shraddha has a query saying, students A, B, and C, how the questions can come in the exam. So maybe what we can do is, how the questions can come in the exam, we can have a discussion on this point towards the end of our session. Instead of just discussing this now, because some of the questions like we have discussed in terms of MCQs are the ones which we have picked up from the chapter. Okay, and various other questions could be descriptive, but in terms of this general sort of thing which can come, we can have a discussion towards the end of the session. Fine. Okay, so I was talking about the liabilities on the auditor. Now, if you look at various regulations, now what are those regulations? For an auditor, there are certain regulations which are prescribed by the Companies Act. Means if there is any non-compliance, if there is any breach of duty, then the auditor would be held responsible for the same under the Companies Act. Then we also have, let's say, income tax, which requires certain compliances to be done. Otherwise, that will be considered to be a sort of negligence. Then we have ICAI, which is also regulating various activities of the audit. Yeah. So all of these aspects are what we are going to discuss one by one. One thing is for sure, that when it comes to the audit, whether it is about audit of the financial statements, whether it is about tax audit, which requires audit of the form 360, or whether it is about audit of, say, any other thing, wherein some sort of attestation is required, wherein assurance services are involved. Auditor is expected to exercise due diligence. See, if we talk about an auditor today, auditor is somebody who is a professional. So that's why whenever any professional will perform a work, some level of expertise is expected out of him. Why? Because he is supposed to be an expert in respect of the area that he will be handling. With the skill set which that auditor will be having, with the level of knowledge which that auditor will be having, he is expected to perform those activities, those projects, those assignments, or those acts in a certain specified manner. And that's an expectation because of the professional expertise, or you can say because of the knowledge which is again expected that the auditor would be having. So that's why auditor cannot just take the plea that because he was ignorant, because he was negligible, because he was just negligent in terms of certain activities, so that's why he should not be held guilty. If at all any mistake is made, which could have been avoided, if the auditor would have exercised significant or if the auditor would have exercised his due diligence in respect of his activity, auditor would be held guilty over it. So that's why auditor needs to be very careful in terms of various activities that he perform. Auditor needs to be mindful in respect of all of those activities. Alright, clear on this? Yeah. So now, auditor's liability could arise due to negligence, as we discussed. Number 2, auditor's liability could be in the nature of civil or criminal, and there are also certain liabilities which are prescribed under the income tax act. But all of these liabilities are the one which would arise if the auditor is but he has shown negligence in his work. And how can this negligence be avoided? Through this due diligence. Okay, yeah. So this is something which is very important on the part of the auditor. So let's try to understand some of these terms. Every person who enters into a learned profession like audit undertakes to bring to the exercise of it a reasonable degree of care and skill. And how is that expected? If he would exercise due diligence. If this would be missing, then definitely a lot of things will get missed. He does not undertake, if he is an attorney, that at all events he shall gain his case, nor does a surgeon undertake that he will perform a cure, nor does he undertake to use the highest degree of skill. There may be persons who have a higher education or greater advantages than he has, but he undertakes to bring a fair, reasonable, and competent degree of skill. So no. So this absence of requisite skill or failure to exercise reasonable skill can give rise to an action for damages for professional negligence. Okay, yeah, which is something which should be avoided by the auditor, or which he should be mindful of, because these type of things can impact him significantly. Yeah. Now, looking at certain aspects wherein the auditor can take the assistance of various other persons in terms of discharging his duties. Now, how can this be done? See, when it comes to the performance of a duty on the part of the auditor, as you would have discussed already under various auditing standards, there are ways through which auditor can improve his work quality. And what are those ways? he can involve various experts. And those are called as experts of the auditor. So we are not talking about the expert of the management. We are talking about experts of the auditor. So for example, we discussed that there's a company which is using IT environment in a very significant manner, and therein the auditor was not considering involvement of an IT expert. Now, even though an auditor will be a chartered accountant, okay, who would be having knowledge of various areas. Let's think about it. A chartered accountant who would be having the knowledge of accounting, they would be having the knowledge of audit, they would be having the knowledge of income tax, you would also be having the knowledge of indirect tax. Yeah, he would also be having understanding of the IT systems. But at the end of the day, he is also a human being, and that's why he cannot be an expert in all of these areas. So no. So it is not possible for a person to become expert in each and every area. Correct? He may have an expertise in say one or two areas, but he cannot be an expert or considered to be an expert, and he should also not consider himself as an expert in each and every area. That's not possible. And with the kind of environment we are into right now, where the things are so dynamic, where the requirements are tremendous, it's practically very, very difficult for a person to become expert. So that's why, if let's suppose auditor is an expert on audit, yeah, and he has got some understanding about these areas. So what should be the approach which he needs to follow? He should involve some experts who can help him on these areas. So he may be required to involve 3 experts, and those 2 experts will only help the auditor. They will only help the auditor in performance of his duties. Okay. Now, because of this, what will happen? The quality of deliverable which the auditor will produce, that will be his audit report, that will be his opinion, will only improve. Why? Because now the inputs in respect of various areas are coming from the experts. Number 2, even though he would have involved various experts, he would have taken assistance of various experts. It cannot be said that the responsibility of the auditor will be passed on to these experts. That doesn't mean that the experts will not have the responsibility in terms of whatever they have done. They will definitely be held responsible for what they have done. But at the end of the day, the opinion which is going on, the opinion which is expressed by the auditor is the responsibility of the auditor and not of all these parties. So that's why, even though he would have taken the responsibility, he would have taken the assistance of various persons, the ultimate responsibility remains to the auditor. So that's why, even though he would take the assistance, he should make sure that whatever limited understanding he was having in terms of various areas, he understands each and every input, and he understands various conclusions and the rationale for those conclusions, the basis of those conclusions, which would have been drawn by these experts and which would then have been used by the auditor while expressing his opinion. Yeah, only then he will be considered to be diligent. Otherwise, he will be considered to be negligent. Correct? Like we just discussed. That's why, what do we say? That's why we can say that in terms of performing his various duties, even though he may engage various parties, the ultimate responsibility lies with the auditor only. Okay. Now, when it comes to this negligence, this will also comprise of certain parts. Negligence. So this negligence has got some parts, or you can say has got these elements. Let's understand what we mean by this. Existence of duty or responsibility owed by one party to another to perform some act with certain degree of care and competence. Occurrence of a breach of such duty and loss or detriment being suffered by one party to whom the duty was owed as a result of negligence. Yeah. So all of these are therefore considered as negligence in respect of whatever work has been done. That's why it's important to understand one thing. To whom is the duty owed? This is very, very important. To whom is the duty owed? So what does it mean? It means that we should first of all understand the responsibility, the duty, and towards whom is that owed. Because only then we'll be able to move into the right direction. Yes or no? Only then we'll be able to move into the right area. Only then we'll be able to pick up the specific aspect related to audit. Here, a professional man is deemed to have been negligent only when he owed a duty to a person or persons and he failed to perform or performed it negligently. Further, if a loss had been suffered by a client through the action of the auditor, his liability will be determined on the basis of the contract of the engagement according to which auditor had undertaken to provide the service. When loss has been suffered by a third party who is not privy to the arrangement between the clients and the auditor for determining whether he is liable, it is necessary to find out. Whether the auditor owed any duty to him, to that third party. Yeah. Now for this, there are various legal decisions. There are various case laws. So what we will do is, we will pick up some of those case laws to try and understand what are these liabilities, what have been the problems, and how some of these things were really dealt in terms of the negligence on the part of the auditor. But one thing is very clear, that when it comes to the negligence or when it comes to anything which is required to be done by the auditor needs to make sure that whatever is ultimately required to be done by him, he owes that. And he owes that towards the person with whom he had an agreement. Agreement means he had an understanding that this is something which I am supposed to do and I am supposed to do for you. And if that is not done as per the expectations, or as per the understanding that both of us had, then definitely that person. Okay. So case of Ultra Mayors Corporation versus Tush. Ultra Mayors upheld, so this is the finding now. So what was the finding? Ultra Mayors upheld the privity of contract doctrine under which third parties cannot sue auditors for ordinary negligence. However, Judge Cardozo's decision extended to primary beneficiaries the rights of one in privity of contract. Hence, Ultra Mayors as a primary beneficiary could sue and recover for the losses suffered because of the auditor's ordinary negligence. Why? Because this is the party which was party to the contract and which also suffered the losses. Auditors were the defendant in this case. They failed to discover. So what was the problem? They failed to discover fictitious transactions, which resulted in overstatement of assets and overstatement of stockholders' equity. Stockholders' equity means shareholders' funds. On receiving the audited financial statements, Ultra Mayors loaned Stern large sums of money that Stern was unable to repay because it was actually insolvent. Ultra Mayors sued the CPA firm for negligence and fraud. Okay, so let's understand what was the judgment or the decision. The court found the auditors guilty of negligence but ruled that accountant should not be liable to any third party for negligence except to the primary beneficiary. Who is the primary beneficiary? Means the party. That means the client. So let's suppose we have got two parties. Let's suppose we have got two parties. One is the auditor and second is the client. So now, who is the primary party in this case? Or you can say who is the party towards the auditor will carry the responsibility. It will be his client. Yeah. Over and above this, there can also be third parties. Yeah. Okay. Here. An analysis of the decision reveals several significant environmental factors that are particularly interesting in view of the current legal environment. First, the judgment recognized that extending liability for ordinary negligence to any third party might discourage individuals from entering the accounting profession, thus depriving society of a valuable service. Second, he feared that the impact that a broader encroachment on the privity doctrine might have on other professionals such as lawyers and doctors. Yeah, because the principles are drawn from, of course, various case laws only. Third, the decision reaffirmed the auditor's liability to any third party for gross negligence or fraud. All right, clear? Now, liability towards other beneficiaries. Ultra Mayors' decision remained virtually unchallenged for various years, for a number of years, and it is still followed today in many jurisdictions. However, several court decisions have served to extend the auditor's liability for ordinary negligence beyond the privity of contract doctrine. Yeah. So let's look at one of them. Let's look at one of them. The first shift away from this ultra mayors occurred in the form of judicial acceptance of the specifically foreseen class concept. Let's understand this concept. If the client informs the CPA that the audit report is to be used to obtain a bank loan, all the banks are foreseen parties, but trade creditors and potential stockholders would not be the part of the foreseen class. The liability will in such a case be limited to losses suffered through reliance on the information in a transaction known by the auditor or a similar transaction. In the above instance, this means that the accountant would not be liable if the audit report was used by a bank to invest capital in the company's business in exchange for common stock instead of granting a loan. Okay, now if you look at this, so this foreseen class concept does not extend to all the present and future investors, stockholders or creditors. Court decisions have not required that the injured party be specifically identified, but the class of persons to which the party belonged had to be limited and known at the time the auditor provided the information. All right. Yeah, clear on this. Then we also have got certain Indian scenarios with respect to this. We'll also come up to that aspect. So what we can do is now we can pick up one more scenario to understand about this breach of duty, this negligence, and how this liabilities may arise. Okay, so let's look at this case. Commissioner of Income Tax versus GM Tendulkar. This is the only decision on the auditor's liability to a third party by an Indian court. So let's look at the findings of the case. Mr. Tendulkar had been engaged by Messrs. A. Mohammed and Company, Madras, and had prepared the statements of account and income tax return on the basis of accounts produced to him. So what did he do? He prepared the statements of accounts. So you can see he prepared the balance sheet, income tax returns. The balance sheet means the financial statements, etc. and the IPO. So he prepared financial statements, he prepared IPO. Okay. During the course of assessment, it was discovered that Messrs. Mohammed and Company, who is Messrs. Mohammed and Company? Client. So Messrs. Mohammed and Company was the client. And who is the professional here? Mr. Tendulkar. During the course of assessment, it was discovered that Messrs. Mohammed and Company had maintained two sets of accounts. One that was regular day books and ledgers for the open market transactions, and a separate book for the black market transactions. Okay, so two sets of books were maintained by them. One for the transactions which were reported in a way, and the second one for the black market transactions. While the former contained detailed entries relative to daily transactions, latter contained only consolidated entries made at the end of the week of the transactions of that week. At the end of the financial year, all the weekly entries in the separate set of books of accounts were called up and were entered in the regular books of accounts. Mr. Dandekar had examined only the regular books of accounts and prepared these two on the basis of the regular books of accounts. All the statements were signed by him. Who signed the statements? Mr. Dandekar. And there was also endorsement at the foot of the balance sheet. Is the financial statements that it's been verified and found to be correct. So over here, professional specified, verified and found to be correct. Okay. Mr. Dandekar had forwarded the statements of account to the income tax officer, and while doing so, had stated particulars of books of accounts that he had examined. Okay, he had stated that there is some record, there is some information which he has captured, which he has considered for the preparation of these two things. Alright. Okay. Now let's understand what was the outcome of this case. So we have understood the fact pattern, and I am hoping you have all understood this fact pattern. So let's understand the outcome. What was the judgment? Which was the decision in the case as regards the duty of this profession. Alright. On examination, the statements of account having been found to be wrong, definitely these were wrong because these were capturing only the limited information. Because there was two sets of books, but only one set of books was considered for preparation of this. Definitely this information was incorrect. Yeah. Income tax department took up the matter against the professional, Mr. Dandekar, and filed a complaint with the ICAI. When the matter was subsequently considered by the Madras High Court, it was held that Mr. Dandekar was under an obligation to perform audit with due skill and diligence. Now, this is very, very important. He was expected that he would perform the audit, and if he would perform the audit, then in an audit, application of skill set is expected. Exercising due diligence is something which is expected. So it's understood. It will say it's not something which the auditor needs to specify. It is always expected. So it is by default that any party would expect the auditor to apply the skill set which he would be having, because that's why auditor has been hired. He would be required to exercise his due diligence. Yeah, if these two are not there, then definitely it's not something which was expected out of him, agreed from him. If he did that, it would be difficult to see what further obligations he had in the matter and in favor of whom. The accountant is under a duty to prepare and resend correct statements of account of the assessee, and he should, of course, neither suggest nor assist in the preparation of false accounts. But he is under no duty to investigate whether the accounts prepared by the assessees are correct or not. The charge is that he owed a duty to the department to himself investigate the truth and correctness of the accounts of the SSC and not merely to act as their post office in transmitting them. So currently, it cannot be said that he has just taken the information from the client and sent to the department. Because what is his role? His role is to audit. And if during the course of his audit, he finds that the set of information which he has received from the company captures the data only from one set of books and from the second set of books is missing, then this will be considered as a negligence on the part of the auditor only. Yes or no? We do not agree, further mentioned, we do not agree that the respondent is under any such duty to the department and therefore no question of negligence arises. Okay, yeah. So now, moving further, if we can do just pick up certain scenarios. We have discussed about the breach of duty. Now we can pick up certain scenarios, cases which will involve civil liability of the auditor for negligence. And this is something which we can only discuss and understand with the help of some case laws only. So I'll pick up some case laws so that we understand. Cases concerning civil liability. Okay. So let's pick up this one. London Oil Storage Company versus CRXL Company. In this case, auditors were charged with negligence for failure to discover the misappropriation of petty cash balance, which was shown by the petty cash book at $799, but in fact was only 30. The auditor was found guilty of negligence in not verifying the petty cash balance as part of his audit procedures, but the damages awarded were limited to 5.5 pound on the ground that damages suffered were not due to the conduct of the auditor, but that of the directors who were guilty of gross negligence in allowing the balance in the hands of petty cashier to increase to such a large number. Further, let's look at one more case scenario. This is Trisure India Limited. Just let's look at this one also. Okay. Trisure India Limited issued a prospectus of February 75 inviting public to subscribe its share. The prospectus contained the report of the auditors, that means the defendants, on the accounts of the company for the year 1973-74, which showed that there was an abnormal rise in the rate of profits for the year 73-74. The public issue was oversubscribed, and the company proceeded to allot the shares as per the terms of the issue. Later on, an investigation was done. There was some problem. So later on, an investigation was done. Now, this investigation revealed that the sales figure for 73-74 had been manipulated by a whole-time director of the company with the active cooperation of the other top officials. So that means there was a fraud. Fraud in terms of revenue. So this was willful. Yeah, this was willful. And the top officials, top management, directors of the company were involved. On discovery of this, the company offered to refund all the monies which were subscribed by the allottees and also proceeded to sue the auditors for damages of rupees 63.85 lakhs. Okay. Company alleged that the auditors failed to examine and ascertain any satisfactory explanation for steep increase in the rate of gross profit, gross and net profits. So there were two parties over here. One is the management and second is the audit. There's no doubt that the fraud was conducted. There's no doubt that the fraud was conducted with the help of the auditor. Yeah. Sorry, with the help of the top management. Not the auditor, sorry, with the help of top management. There's no doubt they were involved. Now the question mark was around the audit, around the audit quality, and why the audit could not capture this fraud. Okay, so around that we are having a discussion. Company alleged that auditors failed to examine and ascertain satisfactory explanation for steep increase in the rate of gross profit, net profit. The other charges leveled against the auditors were whether consumption of raw material was commensurate with the sharp increase. Yeah, whether consumption of raw material, well, that cost was okay. The reasons for disproportionate ratio of total debts due by the trade debtors to turnover as compared to the previous years. Reason for material variation in the ratio of value of stock on hand to the cost of turnover for the year 72-73 and 73-74. So certain ratios which they should have analyzed, they would have gone significantly changed as compared to the last year. So question marks were raised as on these items also. Whether there was any change in the prices of prime raw material, whether there was any improvement, deterioration in the usage of material, whether the company had got new customers, or there was any change in the terms of credit to the customers, whether the production for the year was adequate to support the volume of sales and the closing stock for the year. Yeah. So all of these question marks were raised. Court held that plaintiffs were not able to prove that the auditors were negligent in the performance of their duties. The suit was therefore dismissed. But regarding the duties of the auditor, court held that. Now this is important for us to understand. Auditor is required to employ reasonable skill and care, but he is not required to begin with suspicion and to proceed in the manner of trying to detect a fraud or a lie unless some information has reached which excites suspicion or ought to excite suspicion in a professional manner or in a professional man of reasonable competence. And auditor's duty is what? That is to see what the state of company's affairs actually is and whether it is reflected truly in the accounts of the company, upon which the balance sheet and the P&L are based. But he is not required to perform the functions of a detective. Yeah, his role is to audit. Yeah, wherein he is required to perform reasonable assurance. It is not about giving an absolute assurance. So that's why he will not be extending to investigation. He will not be extending to detection. What is reasonable skill here? What is the skill set? must depend on the circumstances of each case, where there is nothing to excite suspicion and there is an atmosphere of complete confidence based on the record of continued success in the financial matters, less care and less scrutiny may be considered reasonable. Now, this is something which is judgmental. Yes, that's the point which we also need to understand. Thus, the judgment has re-emphasized that an auditor need not proceed suspicion unless the circumstances are such so as to arouse suspicion or ought to arouse suspicion in a professional manner of reasonable competence. The practice of resorting to selective verification or sampling or test check where internal controls are found to be satisfactory by an auditor has also been upheld in his judgment. Okay, so here again, if we have to just quickly summarize this point, what do you understand? In this case, again, we understand that auditor is expected to perform his audit or his work in a manner which is agreed and which is something which he'll do by applying the skill set for which he has been hired. And no doubt, the second aspect, which is the most important aspect, is about exercising the due diligence. If the auditor can prove that he has done both of them, then that is absolutely okay. And beyond a point of time, you cannot expect an auditor to perform each and everything. Yeah? Clear? Yeah? So same is the thing which has also been held in some of these case laws. Now there are some more aspects to it about civil liabilities, around the criminal liabilities. Yeah, so we'll cover all of these aspects also. But I think we can now take a break. And after the break, we will continue with our discussion on these aspects related to civil liability, criminal liability. So Shri Ranjini is asking what is meant by civil liability. So let's understand about this criminal liability. We'll understand. So something which is in the nature of criminal liability is the one which involves criminal prosecution, criminal proceedings on the part of the auditor. Other one is not the criminal one. That's the civil liability which arises. So something which we have just discussed. All right, clear? So with this, I think we can now take a break. And after the break, we will continue on the remaining part. Yeah, so let's take a break. Ram. All right. So now moving further on to the civil liabilities under the Companies Act. So now we'll understand the provisions of the Act in relation to those civil liabilities. Now, this is a very famous remark that auditor is a watchdog and not a bloodhound. This basically clarifies the scope of an auditor. That the scope of the auditor is limited to obtaining the reasonable assurance, and that doesn't really extend to becoming or being a detective, or an investigation is not something which the auditor is expected to perform. Yeah. So now let's understand the civil liabilities. A civil action against the auditor may either take the form of claim for damages on account of negligence, or that of misfeasance proceeding for breach of trust or duty. So let's understand first of all the damages for negligence. Yeah, and these happen to be civil liabilities. Something which you asked me. So these are nothing but the civil liabilities. Civil liability for misstatement in the prospectus. Now, prospectus is what? Prospectus is the document which goes out to the investors, to the prospective shareholders, on the basis of which they make the decision whether to invest in the company or not. And that's why this document is considered to be very, very important document. And this document also contains certain particulars. You can say some part of this document also belongs to the auditor in a way that they are required to certify them. They are required to audit them. Okay, so that's why if there is any misstatement in the prospectus, that is considered to be a very serious negligence. Civil liability for misstatement in the prospectus involve where a person has subscribed for securities of a company acting on any statement included or the inclusion or omission of any matter in the prospectus which is misleading and has sustained any loss or damage as a consequence thereof. The company, now who is responsible? Company and every person who has been a director of a company, who was authorized, who was promoter of the company, who authorized issue of prospectus, and as an expert, shall without prejudice to any punishment to which that person may be liable to pay compensation to every person who has suffered the loss or the damage. But no person, so something which we just discussed, that was subsection 1. No person shall be liable if he proves that having consented to becoming a director, so let's suppose if a director is held guilty, so he can just move away from his liability provided he proves that having consented to become a director of the company, he withdrew his consent before the issue of prospectus, and that it was issued without his authority or consent, or that the prospectus was issued without the knowledge or consent, and that on becoming aware of its issue, he forthwith gave a reasonable public notice that it was issued without his knowledge or consent, that as regards every misleading statement which is included therein. Yeah. He had reasonable ground to believe and did up to the time of issue of prospectus believe that the person making the statement was competent to make it, and the said person had given consent to the issue of prospectus and had not withdrawn the consent before delivery of the copy of prospectus for registration or to the defendant's knowledge before allotment level. So the important point is that if you have to escape this liability, how can you do this? By proving yourself known guilty. And which is possible only if you are able to prove as a director. So we are not talking about the auditor right now, we are talking about the director. So as a director, you need to prove that this misstatement took place without your knowledge, and the moment you got the knowledge about this misstatement, you immediately informed about it and you withdrew your consent. And as regards this information which has gone out, you had only the information which was correct, and the something which has been misstated was not available. Clear on this part? Yeah. Further, where it is proved, that a prospectus has been issued with an intent to defraud the applicants, every person means director, promoter, or you can say the authorized person or an expert, shall be personally responsible without any limitation of liability for all or any of the losses that may have been incurred by any persons who have subscribed to the securities on the basis of such information. Now, who is an expert? Let's understand the meaning of the expert. It includes an engineer, a valuer, a chartered accountant, a company secretary, a cost accountant, and any other person who has the power or authority to issue a certificate in pursuance of any law. Okay, so that means it is in respect of the attestation which would have been done. In respect of the attestation, because when it comes to certification, so an expert would have certified some information in respect of this prospectus, which has gone out, and because of which public or the subscriber to that prospectus would have incurred the loss. So that is something which will make the expert also liable for all these things. Yeah. So there we are not really talking about the auditor, but we are talking about that expert. Yeah. So now that expert could be a chartered accountant who might have issued a certificate, and that certificate may be forming part of the prospectus. Okay. Next is about the liability for misfeasance. What is this misfeasance? This implies breach of trust or duty. Yeah, so trust which has been placed on the expert, or you can say the auditor, and the duty which auditor definitely owes to the person. If there is a breach of this, the auditor of a company would be guilty of this breach of trust or duty. That means guilty of misfeasance if he has been guilty of any breach of trust or negligence in the performance of his duties, and which has resulted in the loss or damage to the company or its property. So in respect of this, we have also got some case scenarios. So I think we can also look at some case scenarios in respect of this. Yes, let's look at some case scenarios. Kingston Cotton Company Mills Limited. In this case, it was held that it's not the duty of the auditor to take stock, and he's not guilty of negligence if the certificate of a responsible official is accepted in the absence of suspicious circumstances. In this case, what happened? Profits of the company had been inflated fictitiously by the deliberate manipulation of the quantities and values of stock. So that means inventory was inflated. auditor has certified the balance sheet on the basis of the certificate of the manager as to the correctness of the stock in trade without checking the stock in detail, and this fact was shown on the fact of the balance sheet. Lopez LJ, exonerating the auditors of the charge of negligence in the course of judgment, made the following remarks. It is the duty of the auditor to bring to bear on the work he has to perform the skill, care, and caution with a reasonably competent, careful, and cautious auditor ordinarily would use. What is reasonable skill? What is reasonable care? What is caution is a matter which must be judged or considered on consideration of special circumstances of each case. Means there is no formula which can be defined. There is no checklist which can be given. There is something which will have to be assessed on a case-to-case basis, and which is very, very judgmental, which is true. An auditor is not bound to act as a detective or as had been said to approach his work with suspicion or with a foregone conclusion that there is something wrong. He is a watchdog, but he is not a bloodhound. He is entitled to rely on the representation made to him by the tried servants of the company in whom confidence has been placed by the company, believing them to be honest and truthful. Must, however, take reasonable care to find that the representations which are made by the company or the company's officials or the management are not palpably false. If any matter is observed which is calculated to excite suspicion, he should probe it to the bottom. Definitely. But in the absence of anything of that kind, he is only bound to be reasonable, cautious, and careful. He cannot be expected to go beyond that. Alright. So then we can pick up another case scenario over here, which will help us to understand this. Okay, so let's look at this next case scenario. Yes. Westminster. Not this one. Yes. SP Peterson and Sons Limited. It was held that the primary responsibility for the accountant of a company is of those who are in control of the company. Who are the persons who are in control of the company? It is considered to be the directors. Okay. In this case, an application had been made by the liquidator that the auditor of the company had been negligent in the performance of his duty and thus was liable to compensate the company in respect of amounts which were misappropriated by an employee of the company, and those amounts had become irrecoverable. So the fact that the defalcation had occurred was accepted. Auditor contended that he had drawn the attention of the directors to the weakness of the system of recording cash and credit sales and had recommended its alteration. Notwithstanding this, the system had been continued. Also, the directors had failed to check adequately the cash reports at the time money was duly handed over day to day by the manager. Yeah, clear on this? This was about the civil liabilities which could be in respect of the negligence or the misfeasance. Now we can move on to the criminal liabilities which may arise. under the Companies Act. Circumstances in which an auditor can be prosecuted under the Companies Act and penalties to which he may be subjected to. Let's discuss that. First, it will be for misstatement in the prospectus. As we just discussed under the civil liabilities part also, that a prospectus is considered to be a very important document. In fact, you would have heard about IPOs, you would have heard about companies getting listed. So the moment all of these events would take place, what would happen? The public interest becomes subject to this, because public at large will get involved with the company. And that's why any of the misstatements in relation to any of the activities or in respect of any of the information which is used in these activities is of very, very significant importance to the public at large, because they need to make the decisions on the basis of this. And if any of the information is wrong, whether it's intentional or intentional, that's a separate aspect altogether. If the information goes wrong, and because of which the investor, we can say the public, has suffered losses in the company, what will happen? The persons who were responsible in respect of those documents, those information, they would be held responsible. And their responsibility is not something which will require them to become liable for the civil liabilities only. They will also extend to the criminal liabilities. Here, for which we also understand as to what could be the punishment for the same. Where a prospectus issued, circulated, or distributed includes any statement which is untrue or misleading in form or context in which it is included, or where any inclusion or omission of any matter is likely to mislead, every person who authorizes the issue of such prospectus, he shall be liable to punishment under Section 447. So we'll understand as to what is that punishment. Then next is about the false statement. If any return, report, certificate, financial statement, prospectus, statement or other document required by or for the purposes of any of the provisions of the Act or rules, any person makes a statement which is false in any material particulars knowingly, means he knew the information is false, so it's a willful act on the part of that person, or which omits any material fact knowing it to be material. There again, the liability will be there in respect of that person who has given that information, knowingly that this information is false. So let's understand what will be the punishment for this. So it's a kind of fraud, correct? So punishment for fraud will be including liability, will be including repayment of any debt under this Act. Any person who is found to be guilty or fraud involving an amount of at least 10 lakhs or 1% of the turnover of the company, whichever is lower, shall be punishable with imprisonment. Yeah, so can you understand now there's imprisonment? So that's why we are calling this as a criminal liability. Shall be punishable with imprisonment for a term which shall not be less than 6 months, but which may extend to 10 years and shall also be liable to fine. So one is the imprisonment plus fine. fine which shall not be less than the amount involved in the fraud, but which may extend to 3 times the amount involved in the fraud. Okay, so that means because of this fraud, what will be the prosecution? Yeah, which will involve imprisonment. And will also involve penalty, or you can say fine. Yeah, so these 2 things will arise. Yeah, clear on this? Where the fraud in question, now this is very important now, because this will also give you some insights as to the public interest or the concerns around the public interest. Where the fraud in question involves public interest, term of imprisonment shall not be less than 3 years. So can you understand the impact? Wherever public interest gets involved, the imprisonment period will significantly increase. Where the fraud involves an amount less than 10 lakhs or 1% of the company, whichever is lower, means less than that threshold, and does not involve public interest, any person guilty of such fraud shall be punishable with imprisonment for a term which may extend to 5 years, or with fine which may extend to 50 lakh rupees, or with both. Okay, clear on this? Now, in respect of this, there is also a direction of the tribunal which we need to know, we need to understand. Tribunal either suo motu or an application made to it by the central government or any person concerned, if satisfied that the auditor of a company has, whether directly or indirectly, acted in a fraudulent manner, or abetted or colluded in any fraud by or in relation to the company or its directors or officers, it may by order direct the company to change its members. This is what. So this is something which the tribunal can do. These are the powers of the tribunal, yeah, which again arises from the provisions of the Companies Act. So this is something which we picked up from the Companies Act only. However, if the application is made by central government and the tribunal is satisfied any change of the auditor is required, it shall, within 15 days of receipt of such application, make an auditor that he shall not function as an auditor. Means the existing auditor within next 15 days should discontinue. And central government may appoint another auditor in this place. Okay. Where individual or firm against whom final order has been passed by the tribunal shall not be eligible to be appointed as an auditor of any company for a period of 5 years from the date of passing of the auditor, and auditor shall also be liable for action under section 447. 447 is the one which we just discussed, wherein we had understood the punishments. Yeah. So now in this case, we are saying that one, in respect of the company wherein the fraudulent event would have taken place, the auditor will be removed, and the auditor who has been removed, that means the outgoing auditor, the auditor who has been removed, will not be allowed to be becoming an auditor of any company. So that means he will not be able to act as auditor in any company. Forget about the company in which the fraud would have taken place. but for any other company also for a period of 5 years from the date of the passing. Yeah, clear on this? Yeah. So such is the impact in case this fraud is found and the auditor is held guilty of this. So I think I missed one query in between from Shivanjani. Shivanjani is asking, sir, under liability for misstatement in prospectus, I could not differentiate which circumstances lead to civil and which lead to criminal. Okay. So please understand that the moment there is a misstatement in the prospectus, so we are not saying that it will lead to either this liability or that liability. So that's why you don't need to differentiate the factors which will lead to these liabilities. That the loss, or you can say, this is such an important matter which requires both the types of liabilities. Alright. So now, moving further, we can now discuss some case scenarios. So we can look at some case scenarios around this. Official liquidator Karachi Bank versus the directors, etc. of Karachi Bank Limited. The directors of the bank made a statement in the balance sheet that the profit earned by the bank in 1927 amounted to 15,608. The amount of profit had been arrived at on taking credit for a sum of rupees 45,214, an amount held in suspense for bad or doubtful items of interest. It was held that the official liquidator should prosecute the managing directors, manager, and the auditors for an offence under section 232 of the Companies Act. Yeah, and this was about old Companies Act. Then, what was the statement? Let's understand the statement because this is the core. This is, you can say, gist of this entire case law. What the directors of the company, of the bank have done is to show a cash profit for that year by adding in a sum which is due, no doubt, but was never paid and was never likely to be paid. The balance sheet therefore contains a false statement and a very material one. And I am unable to see how it can be argued it was not intended to be misled. Understood? Yeah. So such is the impact. That's why this cannot really be ignored. Okay. Now what we can do is we can look at some case scenarios further and which are concerning the misconduct of the auditors under the Chartered Accountants Act. Now the other regulation comes from the Chartered Accountants Act. So Chartered Accountants Act also covers regulations in relation to the gross negligence, in relation to the liability of the auditor. So therein certain case scenarios are available. So let's understand that. And let's understand what decisions have been made, what outcomes have been taken. First, case of Deputy Secretary of the Government, Ministry of Finance versus S.M. Das. In this case, now we are getting on to the facts of the case. In this case, action was brought against Shri S.M. Das. He was the member of the Institute. Institute means Institute of Chartered Accountants of India in respect of alleged negligence in the audit of accounts of RN Bank Limited for the years 1942 to 44. So who is the professional here? S.M. Das. Now it's important to understand the facts better. S.M. Das That's the professional. Or you can say the auditor. Okay. It was alleged that bank had resorted to manipulation of accounts on an extensive scale. Means there was significant manipulation. One of the charges was that in 1944, the bank had shown in its fixed deposit ledger certain large sums as having been received on fixed deposit from certain concerns, in which the managing director was interested, but the cash book of the bank did not show any corresponding entries on the relevant dates. Another charge was that though the auditor had certain doubts, means auditor had certain doubts as around these transactions, as regards the loans which are advanced against fixed deposits, he had not stated the position clearly. Means there was negligence on the part of the auditor. It was also alleged that on a certain date in 1944, cash book showed a cash balance of 5 lakh, although the actual balance on that date was a little over 1 lakh. So there was significant difference in the books of accounts. Auditor in the defense submitted that he had not verified the cash balance in hand and had mentioned the same. So one, the auditor said that I did verify the cash balance. Second, he also specified this. He also mentioned this fact in his special report. Yeah. So let's understand what was the decision, what was the outcome of it. Okay. If an auditor does not do what is his duty to do, it is of no difference for him to say in discrete proceedings that he had told the shareholder that he had not done it. Means something which the auditor was supposed to do, he should have done that. He must have done that. If he didn't do that, and if he makes a statement that I specified I didn't perform this procedure, will not be accepted. Why? Because that was his duty to perform. He cannot just run away by saying that I didn't perform this act. Okay. The lapse is constituted by his failure to verify a duty without which an audit is meaningless. And it is not excused by giving information of the omission to the shareholders. Otherwise, what is the purpose of getting this thing audited? Correct? Authorities, both legal and professional, are unanimous that in a bank audit, the cash balance claimed by the management must be verified by them. So, in case of a bank, this is such an important component. Yeah, you all understand about significant items, significant risk areas. So, this is a significant item over which auditor cannot skip any audit procedure. Yeah, this must have been verified by the auditor, because otherwise the management might remove the greater part of the funds and show them falsely lying cash in hand and thereby relieve themselves of the necessity of making up accounts. Yeah. Of making up accounts showing the disposition of money. In the matter of cash, auditor is not entitled to rely on the certificate of the manager of accepted integrity. In the matter of the second charge against the auditor, that though he had some doubts, now if you remember the facts, auditor had some doubts around this misrepresentation, around this fraud. auditor had some doubts and misgivings as regards certain losses which might be suffered by the bank due to certain overdraft accounts proving to be irrecoverable. He had failed to qualify the report in certain terms, indicating the true position of the debts, and instead had made some cryptic remarks about them in his special report. The learned judge observed either he knew that some of the debts were bad and some of the so-called secured loans were not genuine, but he did not wish to inform the shareholders of that fact, but wanted at the same time to provide for his own safety, and therefore he inserted certain cryptic remarks in his report, or he was careless or neglected to give the shareholders the information which was his duty to give. So in both the scenarios, can it be accepted? So one, if he says that I was careless, so let's suppose if it's true that the auditor was careless, he neglected it, can that be accepted? No, because he is supposed to exercise due diligence. Second, let's suppose if he knew about these problems and knowingly he made these remarks. And why did he make these remarks? Just to protect himself. He knew that there were problems in these accounts for which he should have qualified the report, but he didn't do. Instead, what did he do? He put certain remarks to showcase as if he has been doing his best in certain things he was not able to do, so that he gets protected. Will that be acceptable? The answer is no. Answer is again no. That will not be acceptable. It was held that a respondent has committed a grave wrong, and in consequence, he was suspended from the membership of ICAI for 2 years. The learned judge in his judgment also made following observations as regards the duties of auditors and methods they should follow for discharging them satisfactorily. Now, this is very, very important for all of you, because today if you look at certain provisions, if you look at certain requirements, where do they really come from? They come from these scenarios only. So let's suppose if some wrong event would have taken place for this, or let's suppose some wrong act would have taken place. So just to protect that, some provisions are introduced in the form of the law. So that's why it's very, very important to understand the basis of all of these things. So let's understand what were the observations. Ascertaining, reporting not only whether the balance sheet exhibits a true and fair state of the affairs of the company as shown by the books of the company, but also whether the books of the company themselves exhibit a true and fair state of the company's affairs. If any matter has been kept out of the books, with the result that auditor did not have access to it, he is not responsible for its non-disclosure to the shareholders. In this regard, we can also look at the dictum which is also saying that something which is shown by the company in the books contained in the report, which the auditors make on the statement of account, leave them the responsibility as regards the disclosure of the affairs of the company kept out of the books can be forced. Second, verifying not merely the arithmetical accuracy of the statements of account, but also their substantial accuracy by confirming that they include all the particulars requiring disclosure by the articles or the Companies Act and otherwise represents true and fair state of affairs of the company. Third, checking the accounts verifying the financial statements with reasonable care and skill. For this purpose, auditor may properly rely on the statements of the directors in charge or the managing director, but only if he is satisfied that the representations made by him appear to be honest and truthful. All the matters which are capable of direct verification should generally be verified directly. But matters which require investigation rather than checking may be verified on the basis of representation of officers of accepted competence and integrity, provided there is nothing unusual in the accounts. Okay. Number 4, examining the books of the company and obtaining such information or explanation which he considers necessary, but not with suspicious mind or by proceeding in a manner he would adopt for detecting a fraud or a lie subject, however, to the fact that he is not in the possession of any information which excites suspicion or to excite suspicion of a professional man or reasonable competence. So this is something which we have already discussed in various case laws that we have looked at. Yeah. Next, verifying the existence of assets and liabilities, and you will be able to, I'm sure, relate to some of these points. You could have worked on this. You would have gone through some of these points. You would be now understanding that all these things we are anyways auditing, or the auditor is required to audit, or the auditor is required to look into all of these aspects anyways. And why is that so? Because of some of these events or these wrong acts which might have taken place. So that's why all of these provisions have been introduced, so that auditor exercises due diligence. Next, making a report to the shareholders as would give them information and not merely means of information, in order that shareholders may judge the position of the company for themselves. If the auditor is not satisfied as to the accuracy of entries in the balance sheet, or they are such that if disclosed, they would show the balance sheet in a different way, these facts must be conveyed to the shareholders. Okay? Yeah? Clear on this part? Then I think we can look at another case scenario. This was about controller of insurance versus ICAI BOS. Smaller one, but I think really relevant, so we can also go with this one. In this case, action was brought against Messrs. ICAI BOS and Company by the central government in the matter of audit of accounts of Bhagya Lakshmi Insurance Limited. So this was about an insurance company whose audit was conducted by ICAI BOS and Company. Okay, and action was brought by central government. Clear? Auditor had audited the accounts of the company from 1936 until 1951 and had issued certificate required under regulations of the insurance. On the appointment of the administrator subsequently, a number of irregularities were observed. The principal defense, now the auditor also made a statement, the principal defense of the auditor in respect of the charge was that he had relied on the statements of the management in regard to the matters included in the statements certified by him. Yeah. Now let's understand the judgment decision. So what was the observation? An auditor is not only letter owned, but is also not an insurer. He does not certify the absolute accuracy. Yeah. This is something which you can also understand from the requirements of the audit. Audit doesn't require you to give absolute assurance. It only requires you to give the reasonable assurance. So therefore, we are saying he does not certify the absolute accuracy of the accounts which he audits and approve of. but only says that he has taken all possible care and exercised reasonable skill, and having done so, has arrived at the conclusion which are recorded in the certificate. But if, as we find to our regret to have taken the position here, and auditor does nothing at all in the way of scrutinizing the books of the company, but only relies upon statements made to him by the manager, as his own case find it impossible to hold that he exercised any sort of skill, any care of any kind. Okay. An auditor who construes his duty to the shareholders, to the policy holders, in case of an insurance company, because it's an insurance company, too narrowly, and who passes and approves of whatever is stated to him by the management of the company, whose accounts he audits, does not serve the shareholders with the loyalty or efficiency expected of him, and constitutes, instead of a source of security to the shareholders, a positive danger to them. Therefore, such type of scenarios wherein the auditor is just simply relying on the documents which are produced by the management without performing any audit procedure on them, without performing any sort of skill, any care, that means he is just completely negligent in terms of performing his duties. So that's why in this scenario, auditor was held in duty of gross negligence. Okay. Clear? Yeah? Alright, so now what we can do is, we can just quickly look at some of the liabilities which are also covered under the income tax. So under Income Tax Act, there are certain sections, 288, 278, 271G, then Rule 12A of the income tax rules, which also deals with the penalties, or you can say the actions, yeah, in respect of various matters which are required to be looked at by the professionals. And over here, we are not talking about the auditor, we are talking about the professional. And professional means a chartered accountant for our process. So let's understand the liabilities which could arise under section 288 of the Companies Act. Sorry, Income Tax. A person who has been convicted of any offence connected with any income tax proceeding, or on whom a penalty has been imposed under the said act, is disqualified. So what will happen to him? He will be disqualified from representing an assessor. The Chief Commissioner of Income Tax has been given powers to also determine the period of such disqualification. Okay. Yeah. Now, in this case, let's also understand what are the exclusions, or what are the ways in which an auditor can prove himself guilty. Auditor, so let me just use the term auditor, means the professional. No person who has been dismissed or removed from the government service after first day of federal period, or who has been convicted of any offence, or who has become insolvent, or who has been convicted by any court of law, yeah, shall be qualified to represent an assessee under this act for all times in cases of a person which are referred to in clause A, for such time as the principal chief commissioner or the chief commissioner or the preceding commissioner or the commissioner may by order in the case of a person determined. Further, if any person who is a legal practitioner or an accountant is found guilty of misconduct, yeah, in respect of the professional work that he has been doing by any authority entitled to institute disciplinary proceedings against him, An order passed by that authority shall have effect in relation to his right to attend before an income tax authority as it has in relation to his right to practice as a legal practitioner or an account as the case may be. Further, if any person who is not a legal practitioner or an accountant is found guilty in connection with any income tax proceeding by the prescribed authority may direct that he shall therefore be disqualified to represent an assessor. Yeah? So that means the right to representation in respect of those assessees will be taken. Further, under section 278, let's understand what's the liability. If a person forbids or induces in any manner another person to make and deliver an account or a statement or a declaration relating to any income chargeable to tax, which is false, and which he either knows to be false, that means it's a willful act, or he does not believe it to be true or to commit an offense, he shall be punishable. He shall be punishable. And let's see what's the punishment. In case where the amount of tax, interest, penalty which would have been evaded if the declaration account statement was true, let's suppose if that was true, so that the amount all in all would exceed 25,000 rupees. Yeah, this would exceed 25,000 rupees with rigorous imprisonment for a term which shall not be less than 6 months, but which may extend to 7 years, and with fine. In any other case, with rigorous imprisonment for a term which shall not be less than 3 months, and which may extend to 2 years, and with fine. Okay, clear on this? Next is under 12A, or this rule 12A of the income tax rules. So let's understand what's the penalty over here. Under this rule, a chartered accountant who, as an authorized representative, has prepared the return filed by the assessor. So there is an income tax return. This has been filed by the assessor, as we all understand, but this has been prepared by the chartered accountant. He has to furnish to the assessing officer the particulars of the account, statements, and other documents supplied to him by the assessor for the preparation of the return. Where the chartered accountant has conducted an examination of such reports, he has also to submit a report on the scope and results of such examination. The report to be submitted will be a statement within the meaning of Section 277 of the Income Tax Act. Thus, if this report contains any information which is false, so now we are talking about the information which is going on. If let's suppose that is false, and which the chartered accountant either knows or believes to be false or untrue, so what will happen? Here again, in respect of this false information, this misleading information, he may become liable to rigorous imprisonment, which may extend to 7 years, and this may also involve fine. Okay, so this may extend to the rigorous imprisonment, and which may also involve fine. Okay, so now moving further. On to the next section of the Income Tax Act. If an accountant or a merchant banker or a registered valuer, now three experts are discussed over here. Merchant banker, registered valuer, which is about the valuation work which they are generally required in respect of some of the provisions of the Income Tax Act, and an accountant. Accountant means the professional, means we are talking in the context of a chartered accountant over here. Furnishes information in a report or certificate under any provisions of the Act or rules made thereunder. The assessing officer or the commissioner appeals may direct him to pay a sum of ₹10,000 for each such report or certificate by way of payment. Yeah, clear on this? Okay. So now, these were some of the liabilities which you can say exist under the Income Tax Act. Now, with this, we come to an end to our discussion in relation to liabilities of auditor also. But let's try to understand some of the aspects related to this that we have discussed. We discussed some of the liabilities arise from the requirements of income tax. Okay. So we are saying there are certain provisions which Income Tax Act covers. There are certain provisions which Companies Act covers. Then we also have this Chartered Accountants Act. Yeah. And similarly, there could be various case scenarios, case laws which we look into in terms of assessment of various things. Now, please remember one thing, that there could be certain acts of a professional, of an auditor, which may impact the information, or you can say there could be some misleading information, which is not only going to the income tax department, this may also be reported to the ROC. Yeah, and this being provided by the chartered accountant, so that's why this act may also get involved. So therein, it's not that if there's a liability or there's a penalty, then that will be triggered by only income tax act. And let's suppose if a liability is imposed or a penalty is imposed by income tax act, then no action will be taken under this. No. So it's something that a person will be held liable in respect of that wrong activity under all the laws. Yeah, and I'm hoping this also answers your query, Shiranjini. Yeah, this will only help you to understand this better. Okay, clear on this point. Secondly, the other aspect which we now need to understand and appreciate is that as an auditor, it's very, very important to ensure that the scope of work which we have agreed with the management is performed in a diligent manner. Yeah, there should not be any breach of duty. There should not be any part of work which is not performed by an auditor. And if that is not performed, auditor cannot say I didn't perform this work because that was supposed to be done by me. So he cannot just run away from his responsibility by not doing any part of the work. If there is any problem, then he needs to report that. But he needs to report that after performing the procedures. He can't just report that I have not performed the procedures. That will not be accepted as an excuse on the part of the auditor. Yeah? Because that is something which is expected out of him. And that's why he cannot run away from that responsibility. Okay, clear on this? Yeah. So with this, we come to an end to our discussion on this topic also. Under this topic, as you would have seen, there are various provisions of the law, and to a certain extent, you also need to remember those provisions of the law. But at the same time, it is very, very important for you to practically understand those words. That's why you have so many case laws in the chapter, and I would suggest you to just go through those provisions once again and go through these first laws also. So we have discussed quite a few, but still there are many more case laws which you can also go through, which will also help you to understand this concept in a better manner. Yeah. So with this, we can conclude our discussion. If you have any questions, any doubts, please let me know. Yes, with this, we come to an end to our discussion. Any doubts, any questions before we conclude? Yeah, so we are all done. All right, so with this, thanks to all of you once again for your time and for your wonderful participation today. Yeah, thanks so much. Anji. Okay, thank you.